Everyone to this panel session on the new debt crisis. My name is Roland Rajah and I'm the lead economist at the Lowy Institute. I should also make a plug that I'm also the director of our newly established Indo-Pacific Development Center, which is a new policy research center which we've established at the Institute, which will really gear up in the new year and really focus on economic and development issues in the Indo-Pacific. So please watch this space. Before we begin, let me also acknowledge the traditional owners of the land on which we meet and pay my respects to their elders, past and present. So this session is on the new debt crisis. All of you will know that all around the world, many developing countries are struggling with debt-related issues. They entered the crisis of the last few years with elevated debt burdens. They've been hit with COVID, the ramifications of the Ukraine crisis in terms of high energy and food prices, a high global inflation, a rising US dollar with many debts denominated in US dollars, therefore falling currencies, and rising interest rates and reduced access to global capital markets to roll over all of this debt. And what that means is the ability to recover from all of this shocks is becoming increasingly difficult, and many countries are indeed already in crisis. And then we've got, of course, the challenges of climate change, which makes all of this vastly more difficult, both because developing countries need to finance a huge amount of particularly adaptation-related investment in order to be resilient to the shocks that are coming their way, but also because, of course, climate change also poses significant debt-related problems for many countries. In our part of the world, Sri Lanka, Laos, and the Pacific Islands, these are the countries that face arguably the biggest debt-related risks and problems. Sri Lanka has already defaulted on its debt. It's currently in a deep political, economic, and social crisis. Laos is not yet defaulted, I believe, but is teetering on the edge. China also looms much larger in Laos, both as a creditor but also as a potential rescuer, if you will. And then in the Pacific Islands, in my view, not quite as acute a debt-related situation, but nonetheless with very high debt levels, lots of debt-related problems, and in particular that's where climate change and the vulnerability to climate change and the ability to finance adaptation really starts to bite and interact in a really negative way with these debt-related issues. So Sri Lanka, Laos, and the Pacific Islands, these are the big countries we need to focus on, and I'm very happy to say that we actually have a really excellent panel of experts for you focused on exactly those countries. First, we have Yolani Fernando, who's formerly with the Asia Foundation as well as the Finance Ministry in Sri Lanka, and she's currently studying at IDS at the University of Sussex. And many of you may have seen she wrote a really excellent blog post for Dev Policy, which I think really cut through in terms of what the issues are in Sri Lanka and understanding what's basically gone wrong there. So great to have Yolani here. We also have Professor Keith Barney, who's the head of the Resources, Environment and Development Group at the Crawford School, and his work focuses on the agrarian and environmental change and political economy of development in Southeast Asia, and especially in Laos. And I should say Keith has also written a really great paper on Laos debt problems, which I also recommend. So great to have him here. And finally, last but not least, we have Neelesh Gounder, who's a senior lecturer and deputy head of research at the University of the South Pacific, and one of the Pacific's leading economists focused on that region. So a really great panel. In terms of the format, each of our panelists have a short presentation that they will make. I'll ask them one or two questions in between just to keep the flow going. Then we'll move to a group discussion, including with questions from all of you. So with that, let me invite Yolani to give her presentation.
Thank you, and thank you to the Crawford School of Public Policy and the Asia Foundation for having me here today to talk about Sri Lanka's debt distress, the debt crisis we're currently facing. And I know that Sri Lanka has been in the news a lot for many, many reasons. But I'll be focusing on the side of the story that may not be really newsworthy and doesn't really fit into a tweet. And as mentioned before, Sri Lanka has defaulted on its foreign debt for the first time in its history. And as a result of this, we are facing the worst economic crisis that we have faced in our history since independence. And just to give a quick understanding of the way in which the crisis is manifesting on the ground, and these are symptoms of the crisis that we've been feeling since around November and December of last year, and felt quite acutely in January to March, which is when the protests in Sri Lanka first started. High inflation, massive currency depreciation, severe shortages in fuel and cooking gas, power cuts that lasted up to 16 hours a day in March. They've reduced now, but they're going up and down as we kind of struggle with importing fuel. Shortages in pharmaceuticals and food shortages. And in fact, UNDP has recently estimated that there are somewhere between 5 to 6 million people who are in need of humanitarian assistance in Sri Lanka, and that's for a population of 22 million. About 6.3 million people, they estimate, don't know where their next meal is coming from. So that's just to give you an understanding of the very real consequences of this debt crisis. But how did we get here? So I will give you the sort of the short-term version and the long-term version. Short-term version is this. 2019, government comes into power on many, many platforms, including that of tax cuts. Leads to massive loss of revenue, and then leads us to lose access to international financial markets. So that's in November of 2019, and then we lose access to international financial markets around April of 2020 because our credit rating gets downgraded because we were already in a very precarious situation. We were just getting by, and tax cuts come in, and basically local economists, international banks, credit rating agencies all look at us and say that this is not a good trend. But of course, the government's kind of strategy in this, unfortunately, was one of denial. They were like, nope, everything's fine. Yes, COVID had hit us. Tourism, one of our major kind of earning, one of our major foreign exchange earners is hit, but everything's fine. Don't panic. We have a homegrown solution. And this homegrown solution kind of goes on and on and on, while most people on the other side are asking for a preemptive default. Let's get our house in order. Let's go to our creditors and be like, we can't pay your debt, but we have a plan. But no. And then ultimately, so in 2022, that's this year in January, we pay off a 500 million USD bond. Now, if that was the first domino in our kind of crisis, this was the final nail in the coffin. Because by this point, we had lost access to the markets. We were not earning as much as we should. So we were really dipping into our foreign reserves to pay off our debt. And by the time we pay off that last bond, we are closing to almost zero in terms of our foreign reserves. So, and of course, then on the 12th of April, we suspend foreign debt payments, not really preemptively, I would say, just coming right down to the wire. And all of this to say that this was an avoidable crisis. This is something that people have been looking at and commenting in Sri Lanka and outside of Sri Lanka, and there were so many signs that were ignored for various political reasons. Just to get into some of the more long-term reasons for this. Now, I already said that the tax cuts were the sort of the first domino in that rather terrible timeline. All you need to sort of know here is that Sri Lanka has had a perennial revenue issue. And this is a bit strange because we've had high development indicators. We were considered a model model welfare state. But somewhere in the sort of 90s especially, we started seeing a big drop in tax revenue. And there was some attempt in the previous government's time for fiscal consolidation, but all of that kind of went awry. And what that meant, of course, was that we were heavily reliant on foreign debt for everything to finance our budget, essentially. And of course, when the words Sri Lanka and debt come into a sentence, it's generally followed by trap, and then followed by China. But I would like to say that it's not the amount of debt. As you can sort of see, we've had high debt to GDP ratios across the years, and especially in the 90s and the early 2000s. So it's not really a case of the amount of debt, but the price of debt. And that is to say that in around 1997, we migrated to a middle-income country, lost access to concessionary loans, and what that meant was we were borrowing commercially. Now, of course, commercial loans don't have the kind of grace periods and concessionary interest rates that you would have from loans from multilaterals and so forth. And you see a drastic shift in the composition of our debt from almost like above 90%, being concessionary to it being sort of halved from 1990 to the present time. And the significant year here is the year 2008, when the government of the time, which interestingly consisted of the same people who were in government in 2019 during the tax cuts and now, including the central bank governor, decided that we should embark on a debt instrument known as international sovereign bonds. Now, international sovereign bonds, or ISBs, are a high-risk debt instrument, especially for an economy of our size. And this really changed our risk category. And like I said, the bond that we paid off in January was an ISB. And we really didn't have much of a choice in that matter because they're not concessionary loans. But so all of this, of course, I will kind of come to the point that, of course, is on everyone's minds. Where does China fit into all of this? I would say this, that the default was, in the short term, like I said, one that could have been avoided, one that was and the resulting crisis was a crisis of mismanagement. And ISBs are 36%, that's the largest component of our foreign debt, 36%. However, that is not to say that China does not play a role in our foreign debt. There are a lot of numbers floating around, and I think the blog that was mentioned had a previous number, but as current research kind of puts Chinese debt around 19.6, 19.9%, 20% of our foreign debt being owed to China, and China Exim Bank, China Development Bank being two of the biggest lenders there. And what does that mean? So yes, ISBs are 36%, still larger, significantly. But ISB ownership is splintered among banks, hedge funds, so forth. On the other hand, Chinese debt kind of forms a big block. And what that means for us is that during our debt restructuring negotiations, which are currently in its very early stages, we are going to see China play a crucial role in those debt negotiations. So that, in a nutshell, is it's not much of a nutshell, but that in a nutshell is what the kind of the short-term and long-term causes of Sri Lanka's debt crisis. So just a few, the key takeaways would be, this is a crisis that Sri Lankan governments need to be held accountable for. Successive Sri Lankan governments have not addressed our structural weaknesses for decades. They've kicked the can down the road, left it for the other guy to kind of solve every single time. And ISPs are still the largest component in our foreign debt, and that's an issue in itself. But China will play a crucial role in our debt restructuring process. So I will just stop there. Hopefully did not run over time. And thank you.
Thanks, Yolani. Maybe we'll just go to the next speaker.
Yeah, sure.
Setup works better this way, I think.
Thanks for joining everybody. My name is Keith Barney at the Crawford School of Public Policy here. I'll be talking a little bit about different interpretations of the 2020 to 2022 debt credit crisis in Laos. And I should probably start by saying that I'm not actually an economist. So I've been learning about this sort of on the fly and trying to piece it together as someone interested in political economy and economic geography, but not coming from that, hard economics angle. So if there are economists in the room, I'd be very interested in what you have to say. Laos has sort of emerged as an interesting case study of emerging market debt crises in the last couple of years, and it's been sort of a real climb down for a country that has been doing exceptionally well over the last 2 decades. So over 7% average GDP growth from the early 2000s up until around 2019. It was one of the best performing countries in the developing world, and it's sort of come to a bit of a crashing halt. How can we understand the different elements of this? I won't go into too many statistics, but just to give you a brief sort of overview of the current situation. Public and publicly guaranteed debt is now expected to reach 100% of GDP at the end of this year. So that's, very high for a developing country where, the idea is to debt over 40% of GDP starts to affect economic growth. 50% of the total external debt is to China, so China's playing a very important role. In the last year, there's been a precipitous decline in the Lao Kip, the currency, down 68% year on year. Consumer price inflation hitting 37%, food price inflation hitting 39%. So this is really hitting urban dwellers, people without access to agricultural land. They're getting hit really hard now by this debt crisis. Current account deficit is high, 6.5% of GDP this year, and official reserves are similar to the annual debt repayments scheduled over the next 4 years or so. So there's expectations that those official reserves would not be sufficient to meet debt repayments. So how can we interpret what has happened in Laos? And I'll go through a few interpretations that I've sort of put together from my observations, including expensive commercial borrowing, building on the Sri Lankan example perhaps, the COVID lockdown, perhaps the Ukraine crisis is mixed in there. The third one is China-linked debt in state-owned enterprises, especially Electricity du Laos, the state-owned electricity company. Fourth, a more general interpretation around debt-driven development models. And fifth, real effective exchange rates and Dutch disease. So, and to finish the presentation, I'll just go through a few responses from some of the key actors. Okay, so this was a first explanation that we can think about. And in fact, this is when I started to sort of really pay attention to what was happening with Laos's debt situation. You've sort of been hearing, a few warnings from the development banks through the late 2010s around, the need for caution around debt arrangements. But this development here was really interesting. And this is when I really started to pick up on something was amiss, right? So December 2019, Laos issues a $150 million US dollar bond offering issued by Oppenheimer and Company of New York, the bond issuing firm. And this is an era of ultra low interest rates, and all of a sudden Laos is paying almost 7% on their debt. So, something seems to be happening here that's worth paying attention to. So that was December 2019. As the debt sort of situation became more troubling, there was a World Bank report in January 2021, and they give an interesting interpretation that sort of, well, they stated explicitly here at the top, Laos's debt problems are largely due to extremely high cost of commercial borrowings. And they sort of, contrasted this non-concessional commercial debt and non-concessional commercial bonds with sort of the moderately expensive and less expensive concessional and non-concessional lending from China and the rest of the world. So it was kind of interesting, what was in those red boxes? It wasn't actually quite clear what was the source of this commercial loans and commercial bonds. This was part of it, I suppose, but there was also sort of a lack of transparency on what was inside those red boxes. Probably some of that is debt issued on the Thai securities exchange markets through the late 2010s. We'll talk about that a little bit later. So that's one interpretation. This expensive commercial debt is, there's a lot of interest payments, it's short-term debt, and that really sort of was leading Laos into this debt crisis. Although you can sort of see that maybe that's sort of approximate interpretation and not an ultimate interpretation. If there was underlying debt problems brewing, then Laos might have been forced into that sort of high yield commercial debt market in order to sort of try to keep the wheels going. So maybe that might be not a sufficient explanation. A second explanation, the COVID lockdowns and currency devaluations, and maybe Ukraine comes in here as well. When we look at the decline of the Lao kip over the last year or so, it's quite noticeable, just looking at, you can just Google this on currency exchange websites. You can see the value of the kip just falling off a cliff or up a cliff in that graph there. And in fact, there's a very specific date for when this happens. You can pinpoint it. It's actually September 20th, 2021 that something seems to snap in the Lao currency markets. So what happened on September 20th, 2021? I haven't really been able to find a good explanation of this, but just from looking around, I couldn't really find announcements of a missed bond payment or some kind of statement by a powerful actor that would explain this decline. But what was happening in September 2021, 22 was the COVID lockdowns. So this is when Vientiane was placed under heavy restrictions for COVID. You can see the COVID cases sort of trending up at that point. And in the Diplomat, Sebastian Strangio on September 22, in fact, is saying that Laos is heading into tight COVID restrictions. So maybe that was sort of a bit of a tipping point that sent Laos into this spiral of inflation and currency depreciation and things like that. So that's an interesting interpretation. Again, maybe it's perhaps more of a proximate interpretation rather than an ultimate or fundamental interpretation. Here's another interpretation possible, and I wrote about this with my PhD student, Ganya Suksukun, in a paper published last year in our Crawford journal, Asia-Pacific Policy Studies. So we focused on the role of Chinese lending and overborrowing by Electricité du Laos in Laos's energy sector. And we saw that this was playing a pretty fundamental, pretty important role in Laos's overall debt problems. You can see by the graph here that state-owned enterprise debt accounts for quite a bit of the overall publicly and publicly guaranteed debt, and here's EDL accounting for the majority chunk of that. So what was happening inside this state-owned enterprise that produced sort of this debt configuration? Thinking of Laos, when we think of EDL, you have to think about hydropower. It's not only hydropower, but hydropower is the major portion of investments that EDL makes. And remember that Laos is, of course, a socialist country, one of 5 remaining communist countries. And you can even think back to Lenin's famous dictum that communism is Soviet power plus electrification for the whole country. So that gives a sense of what the role of energy might play in a socialist country in terms of its ideological settings. So prior to the creation of the spinning off of EDL Transmission Company recently, which I'll talk about, EDL held a monopoly on the domestic energy transmission and distribution grid in Laos. It participates as a minority partner in foreign-backed projects and as a sole owner investor. It's located under the Ministry of Energy and Mines, but the Ministry of Finance also plays a key role, including on debt financing issues. But unlike for the commercially listed EDL Gen company, which is listed on the Laos Stock Exchange, EDL, the state-owned enterprise, only conducts internal non-disclosed financial reviews, and these are conducted by Laos's state audit organization and the Ministry of Finance. So there's no public transparency around their debt situation. The chair of the board of directors of EDL is appointed by the Ministry of Finance. So there's an internal regulatory system happening. There's no independent external regulator in Laos, basically. So basically, in the post-2014 period, there was a very ambitious expansion of dams targeting, and this is the key point, dams targeting the domestic power market. We hear a lot of stories about World Bank and ADB support for dam projects, and these typically will have direct power purchase agreements with Thailand or Vietnam. But the dams that were being built by EDL in 2014 were targeting the domestic market. So they were also a borrower for state-owned dams, and they also were the electricity off-taker for joint ventures. So what ended up happening is that they signed a lot of what are called take-or-pay contract agreements, where EDL had to purchase the electricity output of these projects, whether or not there was a domestic off-taker, whether or not there was a buyer. A lot of the dams were financed by China Exim Bank and China Development Bank, and they were these loans were recycled back into Chinese construction companies under what's called engineering procurement construction contracts. These were also noted for their inflated cost structures. So basically, EDL was taking on a lot of risk. They had to continue to pay the hydropower producers whether or not there was a market for the electricity, and this sort of led to this sort of debt situation within EDL. Exacerbating this problem is this issue of a lack of a completed domestic transmission grid. This is a bit complicated, but basically, because the domestic grid is splintered, EDL could not route the electricity to the most efficient buyers. And basically, this left a lot of dams sort of stranded, unable to route their electricity down to the major markets in Vientiane and along the Mekong Plain, for example. Another exacerbating factor is the fact that they were exporting electricity to Thailand in the wet season and then having to re-import it during the dry season at a more expensive cost. This relates to sort of the seasonality of hydropower. And a key case study we can look at for this interpretation is the Nam U Cascade in northern Laos, starting near Luang Prabang. This is a cascade of 7 hydropower projects, $2.7 billion under the Belt and Road Initiative, Power Construction Corporation of China, and Sino-Hydro involved. And they were having trouble finding outputs for the electricity, and they had to sort of follow the take-or-pay contract agreements that were being signed at that time. So basically, there's sort of the interpretation here is that there's a lack of prudential oversight of EDL, but we can also ask, were all the decisions actually being made within EDL? That's an interesting question. Okay, so that's an interpretation that places the center of the debt crisis on state-owned enterprises and EDL. A fourth explanation, a debt-fueled development model overall aggravated by external factors. So this is a new paper just in the Diplomat last week by Sims and Lou Scally. And they sort of say that it's not really China, it's not really hydropower, it's not really they mentioned COVID, but basically they sort of emphasize this idea of a worsening macroeconomic environment and the war in Ukraine. So external factors are really sort of where they place their emphasis. They identify China, but it's just one of a series of actors that have been encouraging foreign debt finance development in Laos. They note that Laos's growth trajectory has actually been sort of slipping since 2010, so there's a longer history to this. And they say that bigger questions must be asked about the exploitative nature of the political economic system in which debt has served as a tool of creditor domination over borrowers. Most people want to get their money repaid after they give you a loan, right? So I'm not sure, we can think about what that means. I guess they're sort of pointing towards an alternative development model as important. Okay, a last explanation, real effective exchange rates and impact on the non-resource sector tradable exports. So I've been talking with Professor Premashandra a little bit on this in the Crawford School, who's an expert in this area. And this interpretation places, the emphasis on this idea of tradable exports. So tradable exports are, things that, Laos exports like electricity, but also, merchandise exports, and the non-tradable sectors like services, restaurants and things like that, things that cannot be traded and exported in that manner. And basically, we can see in these charts here that starting actually way back in 2004, 2005, Laos's real effective exchange rate starts to go through quite a dramatic increase. So basically, that means the Lao currency is strengthening against a basket of other currencies, and it's undermining their tradable export sector, probably. This is related to the resource boom. It's a typical issue that many countries will go through. Australia has gone through its own resources boom and had some of these similar consequences. So, but basically, this, sets up the interpretation of the crisis even earlier, back to 2004, 5, and 6, and reaching a peak in 2016. And this chart, it's a little bit confusing because the real effective exchange rate is the blue line here. You can see that, this is now dropping as the currency is declining. So, I guess this chart might show the seeds of where the solution might lie. The Lao kip is being devalued. This should strengthen the Laos's ability to promote resource and non-resource exports and make the economy more competitive. Anyway, that's an interesting interpretation. There's been a lot of talk about, will Laos default? Will they not default? There's a paper in East Asia Forum saying that the claims of default in Laos are bankrupt because China just won't let Laos default. That's an interesting debate. Another interpretation is that a credit event has already, in fact, occurred. If we look at this paper by Horn, Carmen Reinhardt, and Trebesh in 2021 on China's overseas lending, you can see that there's actually been quite a decline in the number of credit events, sovereign defaults over the last years, but if you add in the number of restructurings involving China, that accounts for the missing the missing debt defaults in different countries. So, one interpretation is that, a credit event has already occurred. This involves China renegotiating Laos's debt profile, and you can see here, forgot this map. That's, oops, darn. That's those missing debt payments there in 2021. It should have been up on that $1 billion mark. Basically, that's the debt restructuring from China that's missing, and that is, in fact, the credit event. So maybe it's already happened, whether or not it actually involved, private creditors and things like that. Okay. So just to finish off, a few quick responses. So what has the government of Laos been doing? Well, first, engage with China, try to extend those debt obligations, negotiate with China. They've been trying to deal with the practical, immediate problem of the fuel crisis that has led to big lineups for petrol stations. You might have seen that in the media. They've been selling off state-owned enterprises. They sold off 25% of one of the jewels of their state-owned enterprise crown, EDL Gen. And they also sold off 2 state-owned banks to local construction companies, which was probably just sort of a recognition that they owed those construction companies a lot of debt, so we'll let you take over those banks. They've been raising funds on the domestic bond market, trying to increase tax revenue. Tax revenue, as in Sri Lanka, is also a factor here. The problem is that at this point, they've got limited fiscal capacity to deal with those other inflation problems that are really sort of hitting consumers and people in their weekly expenditures. Notably, they've been avoiding the World Bank Debt Suspension Initiative and the G20 Common Framework on Debt Restructuring. And we can think about why that might be the case. One interpretation is that as a socialist country, Laos ideally likes to keep Western financial institutions at arm's length, and they would prefer to deal with a socialist partner in China on those debt restructurings. On the other hand, the G20 Common Framework would sit down all of the creditors around the table and agree on an orderly rearrangement of the debt obligations. But we can imagine that there might be some resistance to the level of transparency that would involve if you're the government of Laos. Another interesting development, a few months ago, they declined the release of the 2022 IMF Article 4 consultation report. So this is interesting in that, this would have provided a little bit more transparency on the debt situation in the country. And, when the IMF, this is because Laos is a member of the IMF, they participate in the Article 4 consultations, and any country has the option of disagreeing with the report, right? Like, a country can add their own appendix to the IMF interpretation and say, we don't agree with the IMF interpretation, this is our view. But Laos actually decided to not approve the release of the report at all. So that suggests that there's things hiding in there that they would prefer not to be known. I've heard that there's a representative from the State Asset Management Department of the Ministry of Finance now sitting in the Office of Electricity du Laos trying to figure out what's happening in that state-owned enterprise. So that's an interesting emergence. In terms of the rating agencies, Laos has kind of dropped off international debt markets. Moody's has knocked Laos down to its lowest possible rating before tipping into outright default, while Fitch has just wrapped up their reviews of Laos as a country. Perhaps in relation to that idea that a debt restructuring, a default has already occurred in relation to China. Thailand has been doing some interesting things. Notably in April of this year, despite of all of this, the debt problems, Laos was able to issue a new Thai baht denominated bond on the Thai Securities Exchange. And there's some reports, some suggestion that this might have been sort of politically promoted by the Thai government, that they sort of were directing Thai institutions in order to purchase Lao debt as a, Thailand has a lot of investments in Laos. They've got a lot of interest in Laos. Nobody wants to see Laos descend into chaos. Maybe there was a bit of a political pointing going on around buying up some of those new Thai bond offerings. Vietnam, meanwhile, has been promoting, I think you could say broadly, promoting trade and investment. You can imagine that Vietnam is less interested in providing some kind of financial inputs, which are just going to be, paying off Chinese creditors. China, for their part, has been participating in these sort of non-disclosed debt extensions. They provided a 10 billion renminbi bilateral currency swap, which I think lasts for 3 years. They also engaged in a debt for equity swap where they took over Laos's electricity grid as part of the restructuring of EDL. So now China Southern Power Grid Company owns 90% of Laos's domestic transmission grid. That's perhaps a bit of a sovereignty issue, a bit of a security issue. If China can dim the lights in Laos, that might have some strategic implications. On the other hand, more optimistically, Laos basically needs $2 billion in funding to complete that domestic grid and to be able to route off their excess power efficiently. So maybe with the deep pockets from China Southern Power Grid, they can complete the domestic grid, get rid of that excess power, find good buyers for it, and wiggle their way out of their debt crisis. So that's a possible scenario. Lastly, trade and investment through the Lao-China Railway. We can talk about that a bit. In terms of what the other development partners in Australia is doing, the World Bank has been supporting a public financial management program, trying to get a solid plan for debt reorganization happening and sort of managing the impacts on the economy. There's other ODA assistance for debt recovery. Australia is looking to protect education, health, and welfare support. But in the midst of all this, Laos's much planned graduation from least developed country status, which was supposed to happen in 2020, then got knocked back to 2024, then 2026. This is now all looking a bit shaky. So that's the situation in Laos. I printed off a few recent papers that I participated in here. These 3 papers, you're welcome to come and get a copy if you would like to.
Good morning, everyone. My name is Neelesh and I'm with the School of Economics at USP in Suva. Thanks to Dev Policy for the invitation to come and present here. I came on a direct flight from Fiji to Canberra, although there is no direct flight. So what happened is that as we were about to land in Sydney, we had already left Nandi late. So the pilot was asked to hover around for a while before they gave him permission to land. Our aircraft was also hit by lightning. But the pilot had to land. So when he was holding up, he was too close to Canberra. So he decided to land in Canberra instead. And while we were waiting on the tarmac, I asked him if I can be offloaded here because I had to go to Canberra, and that I'll miss my flight if we go back to Sydney. And luckily what happened, the captain had also run out of his maximum flying hours. So they decided to offload all of us here in Canberra. They set up customs very quickly. They called people from home to set up a customs and let us go in Canberra. So that's a direct flight from Nandi to Canberra. So, yeah. Now I'll start with the debt and economic recovery in Pacific Island countries. So I'll talk about debt and I'll link it to economic recovery because the two are important and the two are linked together. I've deliberately avoided a lot of data and figures, but I'll just start off by showing the debt to GDP ratios in most Pacific Island developing economies, which have increased significantly during the pandemic. So we have 2015, 2019, and 2020, 2021, the pandemic years. And you can see 40% is usually the benchmark that IMF and World Bank puts for debt to be within sustainable limit or level, although sustainability is something that hasn't been defined related to debt as of yet. I'm still not sure what exactly do we mean by debt sustainability. One way the IMF looks at sustainability is if you owe money to country A, and if your loan is due, but you're unable to pay, but you can borrow from a bank and pay off that loan, that's sustainability. So basically your debt remains, although you pay off debt in one situation which is due. So it's a debt restructure. If you can able to do debt restructuring somewhere, that's regarded as sustainability, but your debt remains. So as you can see, most countries in Pacific Island here are above the 40% benchmark, and you can also see how the situation has worsened between 2019 and 2020 and then 2021. Fiji here, as you can see, debt to GDP ratio is now very close to 90%, and it particularly increased during the 2020 and 2021 fiscal years. But the situation was not good even before the COVID impact. For instance, in Fiji, the economy has already started to slow down by 2018, 2019, and debt was on a rising trajectory in Fiji and some other Pacific Island countries. The story also is about tourism-dependent economies and resource-dependent economies. So tourism-dependent economies were hard hit during the COVID compared to the resource-based economies. So Fiji, for instance, was harder hit than PNG because Fiji's reliance on tourism, and as the tourism industry shut down, the entire industry was not. There's basically zero economic activity in the entire tourism industry. And in Fiji, tourism contributes directly and indirectly to around 35% of GDP. So that's very big, and as a result, Fiji was hit the most hardest amongst all the Pacific Island countries. And remittances played an important role during the COVID crisis. So Fiji, for instance, received remittances of around $400 million US, and expecting to receive around $500 million US this year. Similar story for other Pacific Island countries. So remittances basically kept economic activity going as households continued to receive money, and household expenditure, the momentum was maintained. So without remittances, the situation could have been worse in a lot of these Pacific Island countries. So overall, in terms of distress, and this is based on the debt sustainability analysis under the joint World Bank and IMF debt sustainability framework for low-income countries, these countries are now ranked as high on a debt distress: FSM, Kiribati, Marshall Islands, PNG, Samoa, and Tonga. Fiji is not part of this because this analysis is only for low-income countries. But on an individual basis, Fiji's debt rate is regarded as very high. Oops, sorry. So yes, current debt to GDP ratios levels for most Pacific Island countries are regarded as high. And this is by the IMF. It's also important to note that in 2018, Tonga had called on Pacific Island leaders to unite and ask China to write off their debts. Of course, China declined the request. The multilateral institutions and international communities have taken some action in view of the prevailing levels of debt. So this is what happened in 2020 and 2021. Fiji, PNG, Samoa, and Tonga did sought relief and under the deferment of debt repayments under the debt suspension initiative, which was established by the Paris Club, IMF, and World Bank. And actually, 48 out of 73 eligible countries did sought relief from all around the world. And in the Pacific, Fiji, PNG, Samoa, and Tonga sought relief. IMF also approved financing requests to PNG, Samoa, Solomon Islands, Tonga, amounting to $424 million under the Rapid Credit Facility and the Rapid Financing Instruments. These are for different levels of countries based on their per capita incomes. So multilateral institutions and international community have taken some action as well. And the bilateral partners have also supported Pacific Island countries in 2020-21 through budgetary support or cash grants, which would have made the situation worse if those grants had not come in. So what we are seeing now is that the debt service burden is at its highest in some countries. For example, Fiji, the debt service burden is the highest that Fiji has ever seen. For instance, in the fiscal year 2020-2021, 2021 and 2022, 32% of all the revenue that the government collected went for debt servicing. That's interest plus principal payments. So all the 32% of the revenue actually went to debt servicing, and that's big. 19% of government expenditure made up that debt servicing requirements, principal plus interest payments. So the problem that is appearing and is likely to be the case in future if this debt trajectory grows is that more and more government revenue is going to go towards debt servicing requirements. And if that happens, then less and less revenue is going to remain with government for expenditure in public services or for investment in infrastructure and other government requirements and needs. So overall debt distress, this is based on the debt sustainability analysis, is high for these countries, but also moderate now for Solomon Islands, Timor-Leste, and Vanuatu. And this has definitely changed in the last 2 to 3 years during the pandemic. At the same time, we have also seen contingent liabilities have increased as some countries extended loan guarantees to state enterprises. The challenge here is that if the public enterprise default, then the loan burden would fall on the government. And it has already happened in Fiji, for instance. Fiji government had to pay around $25 million loan, which was borrowed by Fiji Sugar Corporation, which looks after the milling side of the sugar industry. It had borrowed, the Fiji Sugar Corporation borrowed $25 million from Fiji National Provident Fund, which is the only pension institution in Fiji. But it couldn't pay it because the government had guaranteed, the government had to pay the 25. So it's real. These things can happen, and this will create additional burden on Pacific Island countries. And we've also seen a rise in contingent liabilities across Pacific Island countries. So no doubt that the situation was not good before the crisis. The crisis pandemic just exacerbated the situation and exposed the fault lines. But it's also important to note that the situation could have been worse without multilateral and bilateral financial support that was received by the Pacific Island countries during the pandemic. So despite the fiscal, despite the economic recovery that we are seeing now in all Pacific Island countries, the fiscal situation is expected to remain weak even after pandemic. Most countries are recovering now, and the pace of recovery is actually good in many countries, better in some countries, better than what we expected, better than what actually I expected, especially in Fiji. The recovery is much better than what I had expected. But the full recovery will still is I think 1 to 2 years away. But even if the economies recover, go back to the nominal GDP levels, to the pre-pandemic level, this situation is not going to go away. The debt scenario is going to remain real, because we have to look at the ability of these countries to grow, expand economically. And given the challenges and the nature of characteristics that Pacific Island countries face, then we can't really argue that the fiscal situation is going to go away. It's going to remain. It may actually worsen in some Pacific Island countries. And given the nature and characteristics, Pacific Island countries face greater risks and challenges than other emerging markets and developing economies. I did a comparative analysis between Fiji and Sri Lanka some time back, which the Fiji government didn't like. And they responded by saying that I'm really biased in the way I've analyzed that. But although we can't really compare Sri Lanka and Pacific Island countries, there's something similar. And that in 2019, everything was great in Sri Lanka. The government said the economy is doing well. Multilateral institutions said it's on a right path. But things can change very quickly. And in Sri Lanka, things change just in 3 years. And so similarly, things can change here as well in Pacific Island countries. Although it's not a crisis at the moment, but we can see the debt distress and the levels of debt and the challenges that Pacific Island countries are going to face and facing now. So first of all is the challenge with low economic growth. If the economy was expanding, and if we expect them to have higher levels of economic growth, then the growth in economy over time would take care of the rising debt. So even though debt is growing, government revenue would grow because the economies are growing. So that would have taken care of the debt. But we are not like the US, which can keep on borrowing, but has the ability to pay back. Pacific Island economies are very vulnerable economies, and we need to recognize the vulnerabilities against which we are comparing the debt level. So 80% debt level may be fine in other countries, but 80% debt level is very high in a Pacific Island country, beyond the mathematics of the percentage in terms of looking at the economic vulnerabilities. So first of all is the low economic growth. This is the continuous challenge in Pacific Island countries, and that means continuous challenge in expanding government revenue, as well as consistent drag on debt dynamics. Fiscal consolidation is not an option in Pacific Island countries. We can't grow revenue as much as we want to, but at the same time, we can't contain expenditure at the same. So this is the challenge that Pacific Island countries are facing, because they also focused on meeting the SDG targets by 2030. Then there's political economic considerations as well. The political side of things, many governments are not looking at cutting expenditure, but actually increasing expenditure. Then the exposure to shocks. Even one natural disaster can wipe off a significant proportion of economic activity and GDP gains. Also, the previous gains can be wiped off because of natural disasters. So this is another potential challenge to this debt dynamic. And expenditure management possible? Very difficult to say that, because Pacific Island countries are now seeking for universal access to social services, closing the digital divide, strengthening climate action. Because of these government actions, it's difficult to say that debt levels in many economies will come down. We expect it to surge in coming years. So the escalation of indebtedness and the increased cost of servicing debt will only become highly challenging in future. I don't see how the problem is going to go away in the near future. It's going to only get worse from here. So the challenges toward economic recovery, I think, is tied together to government revenue, how fast or how good the economies are growing versus the debt levels. What Pacific Island countries really need is new investment, which is more closely linked to the development aspirations of the regions, because governments can't drive everything and they need private sector investment. But Pacific Island countries have found attracting private sector investment difficult. In Fiji, for instance, investment rates have gone down to 13% of GDP pre-COVID in 2019 from 26% of GDP in 2013. So it's half of what it was in 2013. For economic recoveries must be synonymous with inclusive growth. And the areas that Pacific Island countries are hoping to target include agriculture for various reasons. One, of course, is food security, but also because taken Pacific Island countries as a whole, more than 50% of the people live in rural areas. And majority of the population whom we have classified as living in poverty are actually living in rural areas. So there's a strong connection between poverty, agriculture, and rural areas. So I think agriculture will be an important story in the economic recovery, plus the story about inclusive growth. And education would be an important part of the inclusive growth agenda. But also, if you're looking at inequalities, then employment, both rural, urban, and gender inequalities as well. Then the arising challenges related to climate risk challenges, which will definitely pose other challenges as well: agriculture, water, urbanization, etc. Then translating SDGs into a realistic agenda that is tailored to the local development context is really important. So while we have SDGs, member states have signed it, and Pacific Island countries are working hard towards ensuring that we meet those targets, there is still a gap between what is required and how do we get this focus right at the local level, whether there is whether we can fit the outcomes, the targets at the local development level. And my discussions with the stakeholders tell me that there is still a gap between translating the SDG agenda into the local development context. And given the debt challenges and the economic recovery framework, Pacific Island countries are right now working on a Pacific roadmap for economic development. This is the new strategy or framework that will be linked to the 2050 strategy, which was adopted by the Pacific Island leaders some time back. And this roadmap for economic development was approved by the Forum Economic Ministers in August in Vanuatu, which is now being developed. I think this provides an important avenue and opportunity for the region to deal with these challenges. But it will also require regional cooperation and solidarity, which has gone in reverse in some areas. I think regional cooperation and solidarity will be really important in moving forward and dealing with a lot of the challenges that Pacific Island countries are facing. So that's all I have to say, and I'll... Thank you.
So, thank you, Neelesh. My panelists can just join us. Well, thanks to all the panelists for really great presentations, really going in depth in each of those situations. We've got about half an hour for a discussion. I do want to try and leave some time for all of you in the audience to ask some questions. So please just get ready with some questions for our panelists. But I want to sort of just put a couple of questions to each of you and to the group. I mean, particularly on Sri Lanka and Laos. You know, when people talk about debt crises, right, it's always framed as some sort of morality play, right? People want to know who someone's at fault, right? Is it the borrower? The borrower was reckless, or was it the creditor? The creditor was reckless or irresponsible, or trying to do some sort of debt trap, or whatever it might be. When I look at the presentations you've just made, I would sort of, if I'm going to play to that, you know, who's at fault here, it seems to me starts with very serious missteps by the governments, serious policy mistakes, particularly talking about Laos and Sri Lanka here. But the bondholders, the international bondholders, you know, they're really the key enabling factor and problem in terms of providing very expensive short maturity debt that became very difficult to roll over and really essentially triggers the crisis. They enable the bad policy, but then they also trigger the crisis. And then in a more sort of longer term, chronic kind of way, China is playing into this as a large source of debt, financing projects which perhaps are of questionable sort of quality. I mean, if I put that order, it starts with the government missteps, but bondholders are really a big problem in terms of enabling all of this. And then there's China. Do you agree with that sort of framing of if you're forced to argue the moralities of this?
Please go ahead.
Okay, I'll give a shot for Laos. Hopefully you got sort of the idea from my presentation that there's a combination of irresponsible lending and irresponsible borrowing, so involving China and Laos and the whole hydropower scenario. So I wouldn't say that it's a debt trap from China because for this to have been somehow schemed out, you would have had to have control for a lot of factors in order to arrive at the outcome we're at. So I don't really buy into the debt trap argument, but yeah, some poor decision making, I would say, like just not doing a fundamental analysis of what are the demand projections for energy within the country. Is this matched with our new investments in hydropower projects and things like that? So there's that one part. The second part is that real effective exchange rate graph I showed, where you can see Laos's infrastructure and resource boom from the mid-2000s. And I don't think anybody would say that Laos shouldn't have exploited their natural resources for state-led development and economic growth. Every country does that. Australia does that. And perhaps some of that sort of Dutch disease scenario could have been inevitable, I suppose. But I think what they could have been doing is to have been, boosting support for education, investing in human capital, supporting healthcare, and supporting small and medium-sized enterprises. There was a point around 5 years ago, there was a Lao economist who actually said in the Vientiane Times that Laos doesn't have to worry about small and medium-sized enterprise because just a few big projects, and that's our national growth taken care of right there. So, it seems like it was just sort of easy money, right? Big projects, big money coming in. You can hand out the goodies to political people within the country, and everyone's happy. And until it doesn't work out anymore. So yeah.
I think I echo all of those sentiments. Definitely, there's a shared responsibility between in Sri Lanka, the Sri Lankan government, and bondholders as well. There is a question of what are the checks and balances that are there when a country of such a small country, such a weak economy, decides to sort of embark on this sort of almost self-destructive route. Like why was it allowed? Is a question. But I am not going to let our governments off the hook. There was no one holding a gun to our heads and saying you must start issuing ISBs. There was plenty of evidence to say that we should not do that. And in the same way, China did not force us to take those loans. That was part of our decision because we are a country that has grown through consumption instead of developing our industries. And just to give a bit of context, 2008, when we issued the ISB, 2009 was when our civil war ended, and there was this sort of economic boom afterwards. And there was a strong push by the government of the time to show that everything's going great. We are growing, and the infrastructure loans that came from China was a huge part of showing that, we've turned a corner. So I would not let the government off the hook for any of those decisions. But yeah, that being said, of course, there is a question of whether we should have better checks and balances when a government. And that is not to say that the international system or the community should have the right to tell what countries should do, but there should be some framework that is, a bit stronger than what we currently have. Yeah.
Sorry, Keith, you want to say? Yeah.
One last point, I think it's interesting to observe that, there's a really great paper by a Thai-American scholar named Pon Suvanaseng who writes on Lao development issues, and she notes that, I think we can interpret part of this as the shift away from the post-World War II Bretton Woods era development paradigm, where, if you look at Thailand's domestic electricity grid, organized through the Electricity Generation Authority of Thailand, that was funded through the World Bank, the whole thing. They built that domestic transmission grid in the 1950s. so part of Laos's story is, I think, part of the general shift away from that Bretton Woods era of development financing and the move towards a neoliberalized and financialized approach, and that's where the bondholders, so they're just, they're just looking for yield. The Lao government is saying we need to borrow this money and we'll pay you 6.5%, and some people say okay, they'll accept the risk, and so I think that's sort of like a symptom of a broader shift towards neoliberalization and financialization of development.
Of course, when they get paid for the risk, they're supposed to accept those risks, as you say, and that risk is that they won't be paid.
Right.
So,
that's right.
So we can't feel too bad for them if something happens
Right.
along the way. Neelesh, just to go to you on this a similar sort of issue, though. I mean, the Pacific's not in the same sort of situation, but how much is the situation the Pacific is in at the moment? How much is this driven also by the policy settings, right? Any policy missteps on the part of Pacific governments? And I think this is important because when you start thinking about what the international community and international partners should do, one of the things they're always worried about is the so-called moral hazard, right? If you got yourself into this situation, sure, we could help you, and there are ways that we could get you through this providing various kinds of support. But one of the things everyone's worried about is that this is going to encourage more bad behavior in the future. So how much is the Pacific's own policy settings contributing? I mean, you talked about the inability to basically square the books in many ways for structural reasons.
Yeah, thanks. So I also agree with the shared responsibility argument. There's borrower responsibility, but there must be lender responsibility as well. But more so on the borrower side. I don't agree with the debt trap argument because I don't think China was, in particular, for instance, although Chinese loans are significantly less a proportion of the overall loan portfolio, I don't believe China was lending to trap any Pacific Island countries. Whether Pacific Island countries were trapped is actually the problem of Pacific Island countries because they were borrowing. Policy failures, yes. All governments in Pacific Island countries run budget deficits, and one reason they run budget deficits is because the revenue they generate on an yearly basis is not enough to meet the expenditure commitments that they have. So as a result, they need to run deficits, and those deficits are then borrowed to finance the shortfall. On that basis, one can link it to policy failures of the past, and because there have been policy failures, we haven't been able to grow the economies in a sustainable way. We haven't been able to strengthen the economies, and because of that, government revenue hasn't grown over time, and we continue to run budget deficits. So yeah, we can link it to policy failures, but a number of other factors, not only economic policy failures, but on the governance side as well, particularly in Fiji and Solomon Islands, military coups or political instability have cost us dearly in terms of impacting our ability to attract investment and grow the economy over time. And we have elections in Fiji in 2 weeks' time, and which has created a lot of political instability. And if there is instability, then it affects investor confidence, business confidence, and consumer confidence. So all of these are tied together. It's a policy failure on many levels, but also the government's priorities as well, and their inability to control wastages and deal with wastages. But given the political economic considerations as well, I think all angles must be taken into account. In Fiji, for instance, after the 2006 coup, the military government transplanted a constitution in 2013. For them to ensure that the constitution remain and they remain in power, they had to meet expectations of different stakeholders in the society, and to meet those stakeholders' expectations, they had to spend money on different levels. So it's linked to political economy issues and challenges as well.
Two more questions. Just for the group now, we've talked a lot about China. China's always looming in all of these sorts of discussions. All of you have sort of said you don't think there's a debt trap sort of going on. Fair enough, so let's not re-prosecute that, but although I do think that narrative keeps coming back for some reason, which we can also guess. What are we learning, though, about how China does business from the experiences we're seeing in terms of Laos and Sri Lanka, the Pacific? What are we learning in terms of how China lends and then gets itself into these sorts of situations? And then on the other end now, what's China like as a creditor when it's the major creditor in an international debt crisis. I know which one of you would like to go first. Neelesh.
So I don't think Chinese loans are cheaper than other options, multilateral loans, etc. But where Chinese loans were attractive, this is going back, which is not the same case now. I'm talking about going back to 2010, 11, 12, 13, 14, is that there were fewer requirements to meet for the loans to be approved. And that provided the ease of accessibility. So if you do take a loan from a multilateral institution, you have to do an economic impact analysis, social impact analysis, gender impact analysis, etc. These are, and then this needs to be done by independent economists. So you need to go and find someone who's going to do that. There's a fear that what may come out of those reports. So in that case, it's easier to go and take a Chinese loan. We have had this seminar at USP a number of times, and we invited different stakeholders. We invited experts from China as well. And we did discuss these issues. And one of the things we recommended was that they did realize that there is a conception that China is providing loans that are more accessible. So then they asked us what can be done. So one of the things we recommended was to add those additional checks and balances like multilateral institutions have done. And now they've added those on their loans as well. The other condition they had was because Pacific Island countries wanted to build road, bridges, and other infrastructure, they needed money. So, and China was willing to lend them the money, but China was also willing to lend them the capacity to build those. They didn't have the capacity. So a public enterprise from China would come and build those roads and bridges. So you're getting two things at one time. You don't have to find a local contractor who would be able to do that. So Pacific Island countries were willing to take that offer. And China was, the public enterprise would then bring majority of the workers from China, which over time the Pacific Island countries realized was not a good idea because people were seeing that. You're passing by, most of the workers building a road or a bridge are Chinese workers. And we also raised these issues, but now I think they've learned over time. So they're getting tenders still in Fiji, for instance, or other Pacific Island countries, but majority of the workers are local workers. I think they're getting one or two workers who are foreign workers, an engineer perhaps. They want to tender at USP to build a new gate. And I think there's only one worker who was Chinese, but they were all local workers. Yeah, so over time, I think they've also realized, and the Chinese president in one speech also mentioned to Chinese enterprises that if you're going abroad, make sure you do business well, because what you're doing in some countries is giving us a bad name. So you have to be careful in the way you conduct. But also in many cases in Pacific Island countries, it's the locals who teach them how to do business, of how to bypass regulations, how to bypass certain procedures, etc. It's not necessarily they come with this knowledge themselves. It's just a way of doing business, and they get involved in the local culture of doing things.
I just ask if we, just because I want to leave time for some questions next. So we'll go to questions next, but maybe just quick responses from Yolani and Keith.
Yes, if I may add, on the debt trap narrative, just to say that I find the debt trap narrative truly problematic because it casts us as helpless victims. We are either stupid or helpless, neither one of which is a particularly nice image to have. And I would say, don't let us off the hook. We do know what we're doing. Maybe not in the long term, but we do know what we're doing. In terms of what we've learned as what China is like as a creditor, just kind of looking at the way they're kind of conducting themselves in our debt restructuring negotiations, there's definitely been a few roadblocks. I feel like China is also learning a lot through the Sri Lanka experience as much as everyone else. There have been a few roadblocks in the sense that there was a statement by, I think, the Director General of the People's Bank of China that basically said that multilaterals should also be part of the debt restructuring process in Sri Lanka, in general, and definitely in Sri Lanka. And principally, maybe you can agree with that, but practically that's not really on the cards. But I would say that in terms of there's no real indication of hidden debt in Sri Lanka. Even though there is a lot of conversation right now, and I must say that India is sort of indicating that quite strongly in our debt restructuring process. So that's also an interesting dynamic to see, because India does gain a lot from the Chinese debt trap narrative, and they have not been shy about using it. I will say that. Let me stop there.
Keith, any comment on that?
Yeah, just quickly in terms of, I think, what we can learn from Chinese lending around infrastructure in Laos. There was a very marked shift after the Namtun II World Bank supported hydropower dam in Laos, the flagship World Bank project in the country. There was a very marked shift after 2010 away from MDB financed infrastructure. And China really stepped in at that point, and it was because it matched with the interests of the Lao government and sort of the ideological settings of the ruling party in Laos. Laos felt after the World Bank project, I think that they were getting frustrated with the endless consultant reports around environment and human rights, and they didn't feel like this was going to be what they wanted to place their emphasis in. They wanted to move forward with infrastructure quickly. Famously, the former Vice Minister of Energy and Mines in Laos said impatiently, "We don't want to be poor anymore." We're going with Chinese lending, and it's because it was fast and quick and not bogged down in all of these endless reports that were produced by the World Bank in their Namtun II project. So there was a real decision on Laos, I think, to move towards Chinese lending, and it matched with the general ideological settings of the Communist Party in Laos as well. What can we learn from the response? I don't think there's been debt write-offs, although there's not much transparency. I don't think there's been write-offs. It's been debt extensions, debt for equity swaps, currency swap arrangements, things like that are sort of resolving the immediate urgency of the problem, but the medium-term trajectory is still unclear for how Laos is going to try to escape from this debt problem, because there's interest, there's debt repayments due up till 2026, very high debt repayments, and it's still unclear what's going to be, how that's going to be resolved.
Okay, can we go to the audience? Do we have? I think we'll collect 2 questions and try and get through them. I'm sorry we haven't got that much time. Just this gentleman over here, and do we have any other questions? Jenny.
It's already on? Good. Thanks. This has really been a great panel, and thanks to all of you. It strikes me that in many ways, what we're talking about is it's a solid conversation, but it's fairly close in historically. We're talking about an evolution of things that's gone on over the last decade or two, and we're looking out forward over the next 5 or 10 years. If you take the broader sweep of history, what's happening here? Last night, Adil Najam gave us a picture of what's happening with climate change, and it was much worse than the normal story that you hear, and the immediacy of it. We're in it now. It's already upon us. What we're talking about here, I think, and correct me if I'm wrong. What we're talking about here is bad decisions, sometimes corrupt, sometimes politicized, on the part of governments. And Yolani, your point is really good, that you don't want to let them off the hook. They really need to do better. So that's one part of it. The other part is bad behavior on the part of lenders in this new world of moving beyond the older Bretton Woods kind of development financing into one of neoliberal, sort of a neoliberal model. Both of those need to be improved, but they can only go so far. I mean, the reason why you see this bad behavior on the part of governments, there's all kinds of reasons around that, commercial lenders and so on. The question is, if we look out pretty close, the scale of debt that's going to hit these countries in terms of the cost of adaptation is going to rise dramatically. How do we deal with that? Because the kinds of tinkering and improving the current model of debt financing, how's that going to handle debt 2 or 3 times higher than it is today?
And we'll go to Jenny, and then maybe I'll ask the panelists just to pick one of the questions between the two to answer each, for time reasons.
Thank you very much. I just wanted to make a quick comment on the Dutch disease issue. So if you're going through a resource boom where you're getting all the infrastructure in place, to the extent to which you're buying everything you need to do that, you wouldn't expect to see that sort of exchange rate appreciation. So something else is going on. Real Dutch disease is when you then are exploiting the resource, you've got resource rent, and is what you do with the resource rent and the impact on the exchange rate. So I think we need to kind of unpack a little more what's actually happened with Laos' real exchange rate. It's a little strange. That's a really just interesting question. My question is, how do you think we can reshape private sector investment, particularly in the Pacific where it's quite challenging, but also Southeast Asia, because they're clearly going to have to play a role in, the transition to adaptation and climate change and mitigation. But at the moment, they're looking at, if you've got substantial MDB investment, then they're saying, they'll be the absorpting factor. The private sector will be the last to take the haircut on the debt, and yet they're the ones who are charging the higher interest rates. So how do we reshape financial markets, and how do we change government's reactions to financial market pressure? We saw it in the UK. It was amazing. The financial sector finally said, nah, not enough. Liz Truss's tax cuts, forget it. And they had to pull back on it. So how do we get the private sector to actually be a positive actor and actually accept that it's going to not just take the upside, but actually wear the downside, and hence be a much more proactive player in making the investments that they're funding actually work?
Thank you. One of the panelists, Neelesh, would you like to go first? Just one of the questions, please.
Yeah. So I agree with the gentleman up there that it's a real challenge for Pacific Island countries given the climate risks. And this is what I fear. What's going to happen in the future with all these cost, expenditure, commitments, etc., that are going to arise. And I've proposed this in the last few years is debt forgiveness. And I know Roland disagrees with me, but there's something which needs to be relooked at. And there is a moral hazard issue with that, but we can do that on a case-by-case basis. Countries who are experiencing difficulties, challenges, and climate risks, etc., adaptation issues. And so debt forgiveness is one of those ways through which we can, but financing from the climate fund, etc., can also play an important role, I think, in answering your question. And here, I think, attracting investment is always a challenge for Pacific Island countries. Two ways through which I think we can deal with this. One is to identify areas in which we have competitive advantages and develop those areas so it is relatively easier to attract investment, but also create the right political climate with business and investor confidence. We may have the best tax policies, but with bad governance, it's difficult to attract investors. Fiji saw that. It declared half of Viti Levu, Fiji's main island, as a tax-free zone. It didn't receive a single dollar of investment because fundamentally the basics were wrong. Property rights were weak, rule of law, other fundamentals were weak. So I think it's also getting the fundamentals right as well, which is a challenge in Pacific Island countries with the political situation.
I don't disagree with debt relief, I think it is more complicated, that's all, but that's for another day. Yolani?
Agree with debt relief as well, but as much I would say that I don't have specific answers to that question because it's of course very complex. But I would say that Sri Lanka, you don't have to tell Sri Lankans that the climate crisis is now. I have seen it in my very short lifetime. I have seen changes in temperature. I have seen the way extreme weather conditions are wrecking our crops every year. We go between floods and droughts every single year. We are heavily reliant on hydroelectricity, but we can't be anymore. So on that point, you don't have to tell us that the climate crisis is there. We know that. What we don't know is what kind of support the global north is actually willing to give us. Because we have not contributed, much like the Pacific Islands, we have not contributed to climate change in any way, but we are bearing the brunt of it. So the question really is how much support, and this point was brought up at yesterday's very articulate speech about the fact that when we do see something as an existential threat, like we did COVID-19, the money just appears. So this is an existential threat, so maybe the money should appear, but I'm not sure when or where, and I'm not sure if our farmers and our people will be able to, wait that long for the help to come. But we definitely cannot do it on our own.
Keith, last word.
Yeah, just a note on the real effective exchange rate. I agree that it's important to track through that more carefully. My understanding is that, it's not only, the resource exports that led to the exchange rate appreciation. Hydropower and mining are, Laos's main exports and two main sectors of the economy. Also, the fact that, the infrastructure was based on imported machinery and things like that. So basically, I think that would lead to an exchange rate appreciation, and then the Dutch disease parts comes with the undermining of labor-intensive manufacturing as a result of that high exchange rate. So, and I guess, perhaps the cure comes out of that currency depreciation, and that poses a potential for Laos. And this is where the Lao-China Railway becomes really important, because the railway is now operating. There's goods traveling up and down the railway from Vientiane to China, and now comes the tough part for Laos, I think, in terms of, can they develop domestic industries, export-based industries that are competitive around the region, that can, increase tradable goods exports, as opposed to just becoming a transit country between China and Thailand and onwards from there. So, the railway is going to be a real test case, and it's going to be fascinating to see what happens with that. There's been a lot of attention based on the popularity of the railway and the fact that everybody in Laos is enjoying rides on the railway, which is great. At the same time, I look at the ticket prices, and it's like $12 from Vientiane to Luang Prabang, and a similar distance from Paris to London on the Eurostar is around $70 US. So it's not surprising the railway is heavily used when tickets are $12. You can travel the distance cheaper than you would have by bus without spending the $6 billion in infrastructure. So, the popularity of the railway in itself is not indicative that it's going to be profitable. So, and there is a potential contingent liability there if the railway becomes unprofitable. So who would cover that contingent liability is another sort of macro question for Laos to be thinking about. So anyway, the railway is going to be central to Laos's pivot away from only resource-based exports towards value-added manufacturing exports, and that's, which will sop up the excess labor supply within Laos. And this is where, investment in human capital and, the harder work of not just building infrastructure, but getting your logistics systems in place, your export procedures in place. Can you produce things that other people want to buy that meets the market? That's going to be the challenge for Laos.
Thank you, Keith. I'm glad you came to the railway project, because I was really wondering about how that, fitted into the narrative that you told. So can everyone just join me in congratulating our panelists? Thanks, everyone. Hope you enjoyed the panel. That was great. Very good.